Swedish real estate company Fabege just reported their first quarter results for 2025, and there are some interesting takeaways. Their rental revenue reached 865 million Swedish krona, which is basically unchanged from last year. However, when looking at identical properties, they saw a small decline of 2.7%. Property costs increased slightly due to a one-time expense and higher property taxes. This led to a surplus ratio of 69%, which would have been 70% without that one-time cost. The company recorded property value write-downs of 565 million krona, but that's less than 1% of their massive 80 billion krona portfolio. On the positive side, their average interest rate decreased from 2.98% at year-end to 2.91% by the end of Q1. Fabege's main challenge right now is their vacancy rate, which stands at 13%. Management acknowledges this is too high and has set a target to reach 95% occupancy by 2030. The Stockholm office market is facing uncertainty due to global economic conditions, but there are positive signs including increased showing activity and interest in central locations. The company is focusing on 5 key strategies: reducing vacancies, completing ongoing projects, preparing for future development, making value-creating transactions, and controlling costs. They recently sold the Ynglingen property for nearly 1 billion SEK and signed a letter of intent with Solna municipality for another potential sale. Despite current challenges, management remains cautiously optimistic about Stockholm's future, citing its position as Sweden's capital with strong fundamentals and growth in sectors like health and IT. With a solid balance sheet showing a loan-to-value ratio of 43%, Fabege appears well-positioned to weather current market uncertainties while preparing for future opportunities.